All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. If I look a little distracted, this market has just been wild and crazy here today. So I'm looking at my other screens here, trying to keep track of some of these huge moves that we've had intraday. We've had big moves in both directions here the last few days. So it's been a challenge keeping track of the movement. We talk all the time about limiting the amount of time that you look at the markets every day. This is not an approach on our side where we teach our students to look at the markets from opening to closing bell. Ideally, we want to get in and get done as quickly as possible. And that works, I would say, 95% of the time. Days like today, it's hard to take your eyes off the screen because the moves that normally take hours or potentially even days are happening in a matter of minutes. So it's just a lot going on. I'll do my best to recap trading for this week, cover some trades that we've closed out here today, and then also take a look at a couple of markets, a couple of trades that are on my radar for early next week. All right, so let's take a look at the daily chart of SPY. When you take a look at this big picture chart, this is not designed to base our entry and exit points off of. This is really designed to gauge overall market sentiment and gauge how aggressive or conservative we want to be. It feels, I mean, when you start to get into these sessions where you take a look at the NASDAQ just moving 100 points in a matter of a couple of minutes, it feels like the market's completely falling apart. But in the grand scheme of things, when you take a look at this daily chart, it really hasn't been that bad. Has it been a pullback? Sure. Has it been more selling than what we've seen over the past few months? Yes. But when you take a look at it historically, we really, we're less than $20 off of the all-time high. So we're not seeing that panic movement. We're not seeing the washout move to the downside. So far, it's just been a lot of healthy selling. This is good. If we're going to move back up and make more all-time highs here in the weeks and months to come, we need these pullbacks. What we saw going back into January and early February, we were seeing this grind to the upside, but it was coming on extremely light volume. There wasn't a lot of participation. You can see the volume down here at the bottom. On that move to the upside, it was a struggle to hit 50 million shares on a daily basis. Fast forward here to what we've seen the last couple of weeks. Notice the sizes of these daily candles has expanded. They're bigger. There's much better range to work with. And the volume has exploded. We've gone from around 50, 60 million shares on a daily basis to well above 100 million shares. In fact, yesterday, we had 184 million shares traded on SPY. That's a big number, indicating there's conviction behind this move. There's fear coming back into this market. That's going to make it easier for us to get fills on trades and quicker. Now, when you get big volume like this, it typically comes with a pickup in range, and we're seeing that. These moves, again, are pretty big. You can see it on the ATR down at the bottom. For those of you that have joined us over the past couple of weeks, we talked about how this ATR was getting concerning early into mid-February because the ATR was down approaching 4, and the daily range or the intraday range was contracting. There wasn't as much going on intraday. Now we've seen this number explode above 6. We have certainly felt it. We're feeling it here today. The range has been impressive. There's a lot of big moves back and forth. The missing piece has been the follow through. It's been a lot of messy price action. This has not just been a one-way move to the downside. When you take a look at these candles, green, red, and even on these red candles, we haven't had a lot of sessions here recently that have closed near the lows of the day. Even yesterday, selling was pretty nasty midday, and then we rallied up off of the lows. So far today, the low of the session on SPY down around 372.64. We're already $4 off of the low. We continue to see these dips bought. And we've talked previously about how it's going to be a process to break that whole buy the dip mentality that has been so ingrained into pretty much every trader that's been active here in the last few years. It's going to take time to break that, where we're going to have to start to see these rallies sold. And that's what we're looking for here going forward. A lot of uncertainty over the weekend. Are we going to get that stimulus plan passed or not through the Senate? We'll see. Okay, it could very well lead to some active markets early next week as well. As far as support and resistance levels go, here on SPY, we have a big support level right around 371.50. That's our next key area that we want to look for support if this move lower continues this afternoon or even early next week. Okay, we've got the blue lines there. Those are the 89 EMA and the 100 period EMA. Those tend to act as some pretty strong areas of support when they're tested. If we do bounce higher, if we do start to get the Friday afternoon rally, we've seen it so often over the past 12 months. If we start to see that rally, the first area of resistance above us is up at the 50 period EMA, right around 379.80. That would be the next area that we'd want to break up through if we are going to see a near-term low put in place today and see a rally going into next week. That's our key area of resistance above us. Volume, very, very good again today. Here we are just after lunch. 70 million shares have traded today. That's a very active session. So a lot going on for sure. We're going to be well above 100 million shares again today. In fact, we're probably going to be well above 150 million shares come end of the day. So volume, very, very good. The VIX above 28. It briefly got above 30 today. What's interesting, even though the selling has been pretty nasty at certain times this week, the VIX has not exploded like we have seen in previous sell-offs. Is 28 a high reading on the VIX historically? Yes, it certainly is. But we've been stuck in the 20s. We're stuck in the mid-20s now for weeks. So the selling really hasn't brought fear up to the next level. That's interesting. We haven't seen any type of panic selling as of yet. Now, there could be arguments both ways here. Some people might look at that and say, until we get the washout move in equities, until we start to get the VIX to explode, we're not going to see that near-term bottom. On the other side of the fence, people could be looking at that saying, okay, the VIX really hasn't exploded. Maybe it's really not as bad as what the media, what financial media is trying to make it sound. Okay, and I could certainly see arguments both ways. Bottom line is markets are very, very active. And we're going to talk over the next few minutes about why it's crucial here to control your risk in a market like this. When you take a look historically, if you go back in time and you take a look at the NASDAQ making a 100-point move, we've seen stretches where that takes a period of days for the NASDAQ to move 100 points. We have seen 100-point moves in 60 seconds over the last couple of days. If you get caught on the wrong side of those moves, it can get painful in a hurry, right? So not only do you need to control your risk through position sizing right now, but it's also important to choose the right strategies. I prefer risk-defined trades right now. Absolutely. I am not interested in trading undefined risk at the moment. It's just in this market, too much can happen, right? Too much can happen very quickly. And you get caught on the wrong side of an undefined risk trade, it can get painful in a hurry. So one of the approaches that we've been talking quite a bit about here over the past couple of weeks is using more credit spreads. When volatility, when the VIX gets above 20, when it goes above 25, like we're seeing now, what that means is the options are very expensive. The market makers are pricing in that uncertainty into the options, and they become very pricey. You can buy options here. It's just expensive to do so, and you need more to go right in your favor in order to make money. If we use a credit spread, now all of a sudden we're taking advantage of the high volatility. We're taking advantage of the expensive options. We're putting that in our favor. So here's what this looks like. Let's take a look at some of the overnight pop trades from this week. Let's take a look at two of them from last night. Okay, we close out of two more winners here first thing this morning. Let's start out with the NASDAQ ETF. This is symbol QQQ. When we took a look at the market yesterday, when we saw that selling get pretty nasty intraday, and we started to see the NASDAQ come off of the lows a bit, what we did is we said, okay, in the near term, we're oversold. It does not mean the bottom is in. It doesn't mean the selling is guaranteed to be over. But in the near term, we are expecting at least an attempt at a bounce. And that's exactly what we had happen overnight and first thing this morning. It did not last long, which is what you'll see in just a moment, but it was enough to allow us to book the profit immediately within the first couple of minutes of the session this morning. Here's what we did. We were utilizing the options that expire here today. We're using the March 5th weekly cycle. And we came in to put on a neutral to bullish trade that would benefit from the market bouncing higher. We came in and we sold the 301-299 put spread. All that means is I am selling the 301 put and buying the 299 put at the same time. The goal on this trade, I make money if price stays above 301. I don't care if it's a big bounce higher, if we just kind of grind our way higher, any type of a move sideways, even a small move lower would have been okay. We just need a price to stay above 301. Now we sold the spread here yesterday. We collected 58 cents or $58 per spread. It tied up around $142 of our capital to put the trade on. That was the most I can lose in the trade. If I was dead wrong and the NASDAQ continued to just get crushed here today, I would have been out $160. All right, now we went ahead and closed the trade out first thing this morning. We sent out an alert within the first 60 seconds of the market opening, and we closed the spread out for 18 cents. It gave us a $40 profit per spread, which at initial glance doesn't seem like a big profit. That was actually a 28% return on our capital overnight. Now, did we get the continuation to the upside? No, we haven't, right? I mean, almost immediately. If I bring up my 5-minute chart here, let me bring it up. I mean, you guys have been tracking markets here today, so you know how active the market has been. But here's this 5-minute chart of QQQ. We had the higher open. We gapped to the upside, and almost immediately, within the first 5 minutes, we started to head lower. So did we get the bounce to the upside that we were looking for yesterday afternoon? Yes, it just didn't last long. The beauty of these overnight pop trades is in many cases, we're going to be able to close those trades out almost immediately on expiration day. That's exactly what we did today. Booked a nice profit, and that's 12 winners in a row now on the overnight pop trades. They continue to produce really great returns for us. And again, 28% return on our capital. Had you put that trade on 10 times with 10 spreads yesterday, you still would have only had $1,600 of risk. And now all of a sudden, you've got $400 of profit potential overnight. That's pretty powerful, right? You have the ability to control your risk really well with options, especially on these index products because they are very liquid markets. So just a really great trade there on QQQ. Now, had you held, the trade would still be profitable, but now it's trading for 40 cents. So had we held, price has moved right back above 301. We're actually above 303 at the moment. If price stays above 301 here through the end of the day, it would give us the full profit. I just don't want to tie up the capital all day long. I don't want the stress of having to watch this market swing back and forth. I wanted to book that profit as quickly as possible. And that's exactly what we did here this morning. So nice trade there on QQQ. The other one that we put on with our ETF service, we used SPY for that trade. Very similar outlook. It's a very similar process to what we just talked about on QQQ. We were looking for a market bounce this morning. I put on a neutral to bullish trade utilizing an out-of-the-money put spread. And what we did, utilizing the March 5th options that expire at the end of the day today, we sold the 374, 372 put spread, meaning I'm selling the 374 put, buying the 372 put at the same time. We made money if the stock moved up, down, or sideways. We've seen all three of those moves here today. We also made money as time decay added up, which time decay is extreme, this close to expiration. And we would have made money if volatility decreased, which volatility is lower on the day at this point now that the market's trying to bounce higher. Well, we ended up closing out of the trade this morning on that gap higher. We closed it out. Let me grab my fill price here. We closed it out for 21 cents. We bought the spread back for 21 cents here this morning. That gave us a $39 profit per spread. Again, 28% return on our capital. These credit spreads continue to do really well for us. And the reason I love them, there's a couple of main reasons. Number one, they don't take a ton of capital. On this SPY trade, we opened it yesterday for 60 cents. It tied up $140 of our capital. Can you trade multiple contracts, multiple spreads? Absolutely you can. But the minimum requirement, the bare minimum that you need to put this trade on is $140 per spread. It's very forgiving as well. If we were to bought a long call or long put, that's a much more aggressive style of trade. We have to have a directional move in our favor in a timely way in order to make money with that approach. I didn't want to be that aggressive. With the credit spreads, and the price action's been all over the map here today. But yet we were still able to make money because we had 5 ways of profiting on the position. Do you have the home run profit potential? No. You're never going to have a 500% return with a credit spread. Am I going to complain about a 28% return overnight? I will take that every time, especially when we're able to do that multiple times a week. That adds up, right? You can certainly trade long calls and long puts with other parts of your portfolio. I have no issue with that. But this is a way to generate a consistent source of income throughout the week. We have multiple opportunities on SPY every week because SPY has Monday, Wednesday, and Friday expirations each week. And then we have the ability every Thursday afternoon into Friday to look at any individual stock or ETF that has weekly options. We typically take between 2 and 4 of these trades each week. And they just continue to perform really, really well for us. All right, we also closed out of a few additional trades, and I wanted to cover these And we may have some of our students joining us here today. So I just wanted to cover these because we did something a little bit different on these trades today to close them out. Let me take a look at UAL. This is United Airlines, and this is a trade that we put on here last week or a couple weeks ago. And this was another credit spread. The only difference is instead of using the weekly options and looking for the overnight trades, this was a trade that we put on in the April monthly options that still have 42 days left to expiration. We sold an out of the money call spread on UAL, expecting United to pull back. And we sold the 57.5, 60 call spread. I needed price to stay below 57.5, which as you can see today, it's now trading below 50. So it's done exactly what we needed it to do. When I opened this spread, I collected 81 cents per spread. That's my maximum profit potential on the trade. Okay, we were tying up around $170 or so of capital per spread. So very reasonable regardless of account size. When I put a credit spread on, my initial target zone is when I can keep between 50 and 75% of the max profit. Collecting 80 cents, I was looking to close the spread out for between 20 and 40 cents. We closed the spread out for 37 cents here today. So we did something a little bit different in that instead of going for the bigger winner, going for that 75% level, we closed it out early with the partial profit here today. Here's why we did it. With volatility so explosive, with this market very news driven, I wanted to take the profit now while we had it. It's still a really nice profit. It was a $44 profit per spread on the trade. So we were able to see that really nice return. And I didn't want to hold into next week just in case if we start to see rumors over the weekend or early next week of that stimulus plan getting through the Senate. If they start to pump in another $2 trillion into the system, these airline stocks, some of these reopening stocks are going to continue to benefit from that. I didn't want to get caught if the market decided to bounce very quickly next week on that news. In many cases in this market, you've got to be quick. You've got to be quick to act and be okay with the smaller returns. I'm not swinging for the fences right now because as you can see, while I've been talking here, look what the NASDAQ's done. The NASDAQ futures just went positive. These moves are extreme. If you start to take advantage of the smaller returns in this market, it can still add up to a big profit number. Where I see so many people getting caught in this market is they're continuing to swing for the fences, continuing to go for those home run trades. And in the end, you might hit it big every once in a while. But when you compare the numbers, if you start to temper your expectations and be okay with those smaller percentage returns, you're going to see those returns happen more frequently. And in the end, the numbers are actually going to be more impressive. You're going to see a bigger return over time by seeing those consistent profits. Not to mention, it's just easier to handle psychologically when you're not having those big trades on. I'd rather just take a larger number of small positions because in the end, you're still going to end up with an impressive profit number. So that's what we did on UAL. And then one more that we closed out here today was on MU. This is on Micron. And this was a spread that we put on, we put it back on mid-February or so. It was selling a call spread. We sold the 92.5, 95 call spread. And up until the last couple of days, we've been dead wrong. I mean, for the first number of days of this trade, we were dead wrong on the position because the stock just continued to move higher. The credit spreads are going to recover much quicker for you because when price starts to reverse in your favor, remember, every day that you held that trade, even when this directional move was going against you, the time decay was still adding up. So when that directional move does reverse in your favor, like it did here the last couple of days, we were able to go from a losing position to a profit pretty quickly. So we sold the spread. We opened up the spread back in mid-February for 71 cents. I collected $71 per spread. We closed it out here today for 37 cents. It gave me a $34 profit per spread. So again, we are closing them out early, right around that 50% of max profit level. Again, just trying to temper our expectations. We've had, I believe, those two trades on UAL and Micron. Those were our NASDAQ option superstars trades, and we've closed out of 22 winners in a row with that service. So it just continues to perform really well for us. That's the top question I get right now from people. I mean, how are these trades been doing in this wild market? Do I need to go to the sidelines? Do I need to be scared of the volatility? If you are open to using a wider range of option strategies like a vertical spread, like the credit spreads we've talked about today, you're going to be able to react to anything the market throws our way. Doesn't guarantee we're going to win on every trade, but there's always something that we can do to react to these changing conditions. And we can do so defining our risk, keeping our risk small. We love the volatility. There's definitely things that we can do here going into next week. And some of the markets that I am looking at, let's talk briefly about, let me bring up my daily chart again. A lot of what we've seen here today has been a direct result of what we've seen in the bond market. Here is /ZN. This is the 10-year note futures. You could look at TLT if you wanted to as well. The bottom has fallen out here. I mean, bonds have gotten hit for sure. And as a result, equities have started to show some fear, right? Because now, we've seen in the inflation numbers pick up. We started to see some interest rates on the move. As a result, higher interest rates with this level of debt that we have worldwide, but specifically here in the US, not a good thing, right? So until we start to see bonds stabilize a bit, we're due for a bounce. We're very oversold, by the way. But until we start to stabilize, we're going to continue to see uncertainty in this market. And that can lead to bigger moves and higher volatility in the near term. I do expect a bounce, whether it's sustainable or not, we'll have to see. But I do expect the bond market to bounce in the near term going into early next week. So one of the hardest hit areas has been the NASDAQ. Here is the NASDAQ ETF, symbol QQQ. I'm going to start out by taking a look at the 130-minute chart. That's what we have up on the screen. And notice our pulse histogram down at the bottom has gone from red to yellow to green. When it prints green, like it has here over the past couple of days, it indicates price being between a 2 and a 3 standard deviation move on the downside. Less than 2% of all occurrences are going to fall outside of this range on the downside. It doesn't mean price can't move lower. It just means it's not statistically probable. In all likelihood, here in the very near future, we're probably going to see a period of consolidation or an attempt at a bounce. It's a very repeatable pattern. We've talked about that here in the last couple of recap videos that we've done. I am expecting QQQ to either chop sideways or potentially even bounce into the 8-period exponential moving average. That's that blue and red line above us. Currently sitting around, right around 306, just over 306. I would love to see that level tested going into next week. If I want to put on a neutral to bullish trade that would benefit from a period of consolidation or a move higher, how would I play that? You could buy a long call. The problem with that, again, is it's just too aggressive. You buy a long call in this market, the market better move higher and it better do so relatively quickly. If it takes too long or if the move's not big enough, you're going to be in trouble quicker. What I would rather do is to sell an out of the money put spread, just like we talked about with the overnight pop trades, but I'm just going to go out a little bit further in time. Let's go out to the March monthly options. Those are the ones that have 14 days left to expiration. Because I'm expecting a bounce in the near term, I don't mind going with these shorter duration options. So I'm going to open up those March options and I'm going to go out to the 294 put. They have roughly a 65% chance of closing out of the money. I'm going to right click on the 294 puts, go to sell and go to vertical. It's going to pop up an order down at the bottom where I am selling the 294 put, buying. By default, it has me buying the 293 put. I'm going to stretch that out. I'm going to change the 293 to 292. I want there to be a $2 difference between my strikes. As we've talked about in recent videos, I'm okay risking between 2 and 3 to make 1. That ratio works for me. I can make those numbers work. We're going to have a very high winning percentage with this approach because we've got 5 ways of making money on the credit spreads. So if we collect 50 cents, okay, at the time I hit confirm and send, it was trading for 52 cents. So if we collect 52 cents, it's going to leave me with a trade where I'm risking $148 to make 52. So between risk 2 and 3 to make 1. It gives me 5 ways of making money on the position. I make money if the stock moves up, down, or sideways as long as price stays above 293.48. Price is currently trading at 303. Well, it's just past 304 now. So now we've got between $10 and $11 of cushion. This stock could continue to move lower by $10 or $11 and we're still okay. The only move that hurts me is a big move lower below 293.48. Not expecting that because the market is already at an oversold extreme. We already have that green reading on the pulse indicator like we just took a look at. So this would be a trade that would benefit. We make money the fastest on this trade if QQQ moves higher. It just doesn't have to. We just need price action to stay above the short strike, the 294 put. Okay, so we also make money as time decay adds up, which it will every day, and if volatility decreases. So now we've got 5 ways of making money on the position. All right. So if we get filled at 52 cents, that's our max profit. Where would be my target range? I would look to buy the spread back for between 13 and 26 cents. That would allow me to keep between 50 and 75% of the max profit. So that was the first trade that I'm looking at going into next week. The second one is on EA, which is Electronic Arts. Go ahead and load this chart up. You're going to go through a lot of the NASDAQ charts, and you're going to see a lot of very similar looking chart patterns. A lot of these markets are overdone in the near term. Apple, EA, QQQ, Amazon, Tesla. I mean, they're all oversold. Not saying the bottom is in. I'm not saying these can't move lower. It's just in the near term, we're probably going to see an attempt at a bounce like we're seeing off of the lows here today. QQQ is already $7 off of the low. So EA also has the green reading on the pulse indicator, indicating price being between a 2 and a 3 standard deviation move on the downside. So we're looking for a bounce higher. So we're going to also come over to the trade page, and we're going to take a look at selling an out of the money put spread here as well. Now, just to mix up my expiration cycles, let's just see if there's anything else that we can do. Let's say if we can go out to the March 26th, a weekly cycle. Those are the ones with 21 days left to expiration. Looking at these options, I like the dollar-wide strikes. My concern is the volume and open interest numbers are not great. There's not a ton of liquidity here. We may have to go out to the monthlies. Let's take a look at the monthlies. We can go out to the monthlies. They have a little bit better volume picture. The problem is they have $5 wide strikes. It's not a deal breaker. It is more difficult to get filled on a $5 wide spread than it is to get filled on a $1 wide spread. So we'll use the April 16 options with 42 days left to expiration. I'm going to go to the 125 puts. I'm going to right click on those, go to sell, and go to vertical. Pops up an order down at the bottom where I am selling the 125 put, buying the 120 put at the same time. Again, I want to make sure I'm in a risk-defined trade right now. If I hit confirm and send, I would be risking $362 to make 138. So right between risk 2 and 3 to make 1. We make money if EA moves up, down, or sideways as long as price stays above 125. Actually, our break even's at 123.62 because we do have to factor in the credit that we're receiving to put the trade on. So as long as price stays above 123.62 over the next 42 days, we can make money. So it gives us, a $9 cushion where we can be wrong and EA could continue to move lower and we would still be able to make money. So a lot lining up in our favor here. We also make money from time decay adding up and from volatility decreasing. Very forgiving trade, fully risk defined. That's why I love these credit spreads, because if we are wrong, if this just does happen to be an outlier move where the market does tank a little bit over the next couple of weeks, I want to know what my maximum loss is. And these credit spreads allow me to do just that. So this is a neutral to bullish position. We make money the fastest if the stock does move higher, it just doesn't need to. If we just stay right here, if we just kind of chop around for the next week or two, we can still make money there also. All right. Any questions on the EA or QQQ trades? Go ahead and type those in now. If you guys are watching the recording here over the weekend, feel free to post a comment on the video or even email me directly, mike@netpicks.com. More than willing to connect and help out there. The plan of attack for next week, let's just circle back to the daily chart for SPY. So the plan of attack for next week in the near term, we're already off of the lows today. Do expect an attempt at a bounce early next week. That would come into play, especially if they get some positive progress made on the stimulus plan over the weekend. Very well could see another push to the upside. Cautiously bullish in the near term. And then when we jump back on Wednesday for our midweek update next week, we'll take a look and just see, has anything changed? Do we want to look for another wave to the downside? We'll just have to wait to see how the market opens up next week. All right, so I'm going to start to wrap up here for today. If you have any questions on any other symbols that I have not taken a look at here today, feel free to type those in now. And if you would like more details on the overnight pop trades, they continue to do really well for us. We've had well over a 75% win rate here going back to last year. And we've had 12 winners in a row. So we'd love to connect and help you get on board with our next round of setups next week. All right, so I'm going to wrap this video up here. Enjoy the weekend, everybody. We'll talk to you all going into next week. I'll be back on Wednesday for our next midweek update.